Welcome back to Morning Markets on Wednesday, the 10th of March. George Bell here, investment analyst, to bring you up to date on the key market moves of the last 24 hours. Looking first at bond markets, a positive day for sovereign debt as we saw yields pull in. Here in the UK, the yield on 10-year gilts moved in 2.9 basis points to 0.72%. 30-year gilt yields moved in 4.4 basis points to 1.24%. And over in the US, more pronounced moves with the 10-year Treasury yields pulling in 6.6 basis points to 1.53%. And 30-year in 8.2 basis points to 2.23%. This demonstrates a few things, one being the bond markets in the US are responding well to the first of the three Treasury auctions, which we will see this week, second occurring today, but the dominant force continues to be growth and inflation expectations following the revised expectations from the OECD yesterday, so the Organization for Economic Cooperation and Development. Lower bond yields sparked a positive reaction in equity markets, especially those indices which are more sensitive to higher borrowing costs, such as the Nasdaq, which reversed the losses made the day prior, closing up 3.69%. The S&P 500 closing up 1.42%. US dollar was weaker on the day, down around 30 basis points relative to a basket of foreign currencies, but even the UK mid-cap outperforming large cap, with the FTSE 100 up 0.17%, but the 250 up 0.81%. Euro Stoxx 50 was up 61 basis points on the day, and Asia Pacific up around 93 basis points overnight. According to the OECD report, global economic growth, GDP, is projected to be 5.6% this year. That's a positive revision, upward of more than 1% from the December report, of around 1.4% in total. In terms of levels, world output is expected to reach pre-pandemic levels by the middle of this year, with expected growth rates of 4% in 2022. The table on screen now breaks down the growth rates for 2020, but importantly, the expectations for 2021 and 2022. The column on the left-hand side for 2020 highlights the pressures which compulsory activity restrictions placed on economies, particularly developed markets, which faced greater challenges in controlling the continued spread of the virus relative to a number of Asian economies such as China and South Korea. This can be seen by the economic impact for the year, China being one of the only economies posting a positive number for economic growth for the year. As we project forward, we can see the positive trends rolling through 2021 and 2022 in terms of economic growth. The UK, for example, is expected to see GDP growth of 5.1% this year. That's 0.9% higher than anticipated back in December, with strong momentum behind the reopening of the economy, and 4.7% growth in 2022. In the US, the OECD anticipate growth of 6.5% for 2021 and 4% for 2022. So that's a positive revision for both years of 3.3% and 0.5%. We've been getting a sense of this improved growth and inflation expectation in recent weeks from movements in the bond market. The report yesterday provided some clarity around those expectations. The key factors underpinning the positive revision since December are health management, so better control of the virus and the development of vaccination rates, improving the expectation of a faster recovery in activity levels, but also stimulus, and primarily the $1.9 trillion worth of stimulus, fiscal stimulus, that being in the US, which is agreed on top of the $900 billion which was issued in December last year, which will provide a positive boost not only to the US, around 3% of the 6.5% expected growth for this year, but it will also have a positive spillover effect on key trading partners, adding about 1% to the GDP growth for regions such as Canada, for Mexico, around 50 basis points of economic growth for European partners as well. So whilst inflationary pressures were highlighted, sustained inflationary risks in developed markets were not emphasised as a key concern in the report, with the economists referring to the degree of slack in the economy, making particular reference to labour market slack there. In emerging markets, inflation is more of a concern as input costs rise. However, the report did refer to the temporary supply side challenges faced in emerging markets, leading to those higher commodity and input costs. Whilst the rate of headline revision is good news and was very well received by the market, there is an increasing sign of divergence in recovery rates, Europe being an example there. So whilst developed regions such as the UK and US benefit from effective public health policies and faster vaccination deployment. Europe and to some extent the emerging markets are lagging behind on that front. The report titled "The Need for Speed" stated the top policy priority is to ensure that all resources necessary are used to produce and fully deploy vaccinations as quickly as possible throughout the world to save lives, to preserve incomes, and to limit the adverse impact of containment measures on well-being. With chief economists making clear Europe should put emphasis on the faster rollout of the vaccination before policy shifts to focus on the reopening of the economy. So while shifts in policy are not anticipated, the meeting of the ECB tomorrow will provide some interesting insight into the appraisal of current policy measures and vaccine development overall. Thank you for watching.
Thanks for watching. If you enjoyed this video, please leave a like and don't forget to subscribe to the True Potential YouTube channel. If you have any questions or requests for future videos, let us know in the comments.